This is a trader investor. Today I'm going to talk about order blocks, demand zones, and supply zones. I want to show you how I identify trails smart money is leaving behind so we can find precise entries and exits. I am not going to claim that I created this system. I've been doing a lot of studies, and there are plenty of people who have taught me how to take advantage of this system. So right off the bat, I just want to make sure that it doesn't come off that this is my claim, that this is my knowledge. I have just learned this over many years, and I want to share this knowledge and help you understand how they work. How does smart money react to certain market conditions, and why does price move in certain ways? And you hear a lot of words: supply zone, demand zone, order block, institutional candles, mitigation, and these are all related. And as we go in the theory, you will be able to understand what each one of them mean and how they are specifically designed and identified. So everything hinges on this anchor: understanding what the structure is, understanding where area of value is, to have a very precise execution. Once we understand demand zone, order block, supply zone, then we can have tighter stops, we can have better accuracy, we can enter the market with more confidence. It does not mean they work 100% of the time. It just means it gives us higher probability of success, and it gives us fantastic risk to reward ratio. As we are able to tighten our stops, we are able to gain for higher rewards. So that's the context of this whole study, is understanding structure and using the supply zones, the demand zones, the order blocks for our execution. Those become our area of values that we are going to fully take advantage of. So that's very critical to understand that part. So as you think about support and resistance, why do some work better than others? I think a lot of us always wonder, well, I had drawn this support, but it did not hold. I had this resistance, but price went right through it, like a knife through butter. Why? Well, a lot of it could come down to understanding supply zone and demand zone. Price has a tendency to come back to these zones. These zones are liquidity institutions smart money is leaving behind to come back to collect at a later time. So a later time could mean days, weeks, months, or if you're trading it in a shortened time frame, it also works the same way. It could just mean hours, or a couple of days before those zones are revisited, before smart money comes back to collect on those liquidities. And when you see the charts, you will understand the term mitigation. When there is a wild movement that is preceded by a candle of the opposite direction, that becomes our order block. And that order block has to be mitigated. Mitigated means whoever initiated that down move, for example, when price moves back up, they're not exiting for a loss, they're holding that position. And they're coming back to mitigate that loss, because they're on both sides. They're taking advantage of all the gains, and when they're done taking advantage of their gains and price comes back down to that order block, they're mitigating their initial position that took the price down, faked everybody else, and reversed. So it's very critical to understand. So their mitigation happens at the order block. And the supply side, the support zone, the supply zone, the demand zone. The demand is related to support, supply is related to resistance. Those zones are what you call consolidations. When price consolidates before making a wild move to either side, that's the area of supply or demand zone. That's the area of interest because price has consolidated, and we will go into the additional explanation of that. Is when price is accumulating, when they're in a consolidation, that's your demand zone, and price will move higher from there. When price is consolidating at distribution, where smart money is distributing their positions to the unsuspecting retailers, they're exiting to go down, that's your supply zone. And both of those zones will be revisited at a future time. So in an uptrend market, we focus more on the demand zone. We want to take full position when price comes back to retest those zones, and it will reverse back to its original uptrend movement. And in a downtrend, we do the opposite. We focus on the supply zone and follow it down until we take our exits. So that's the focus area, that's the zones. So to go into, before we go into more details, to go into some of the theory, a demand zone, as I explained, is a consolidation before price makes a wild move to the upside. And supply zone is consolidation area before price makes a wild move to the downside. And where order block lies is within this area. In a bullish order block, which coincides a lot of times with the demand zones, it is the final bearish candle before price starts to take out previous highs. So as we see price making higher highs, that last bearish candle is the order block. That order block will not be known to us until price starts making higher highs, because the goal is not to enter when the order block is formed. That we have no way of knowing. Institutions, when they make their moves, they're not announcing it. But we know that this order block formed is an area of liquidity where there has to be some mitigation. And we want to take advantage when that mitigation happens. Keep in mind, not all liquidity is mitigated. Sometimes it's just left open. Sometimes maybe the smart money brings down price to some level, exits because they have captured a lot of gains and they're happy with those gains. I don't know what other reasons they have, but some liquidity is just left there. There is no mitigation for those order blocks. A bearish order block is the last bullish candle before price starts to take out lows. When price starts to making lower lows, that last bullish candle is our order block. And again, this order block will act as resistance for the next time price comes back to test it and potentially reverse back down. This is why I want to focus on the demand zone, bullish order block in an uptrend, because price could hit a bearish order block, reverse very, very momentarily for a small amount of size, and continue its bullish trend. So I don't want to play in that area. I just want to take advantage of the bullish order block demand zone in a bullish market, and vice versa in a bearish market, take action on a bearish order block and a supply zone. And as an entry, demand zone is an area for a long entry, or it is an area for a short exit. Let me say that again. A demand zone is an area for a long entry or an exit for a short entry. A supply zone is an entry for a short position and an exit for a long position. So if somebody was long and they meet a supply zone, this is where they exit. They meet a bearish order block, this is where they exit. And to say it again, a supply zone acts as an area of entry for a short or an area of exit for a long. And taking this theory now into a Wyckoff chart, the Wyckoff theory says markets move in one or two ways. They're either in consolidation or they're trending. And in consolidation, it could be an accumulation or it could be a distribution. Either side tells us whether it's a demand zone or a supply zone. So if it's in the accumulation phase where price has been coming down, and it's finally finding a base and it's staying stable and not going down any further, and volume supports this idea that it's not going down any further, because you will start to see decreasing volume as price is making even lower lows from the selling climax to the terminal shakeout. Terminal shakeout could be a lower low, but volume will not be very strong. So this is a good indication that this is an accumulation, this is a demand zone. And this demand zone could then act as a resistance in the future when price comes back down to test it. And when price comes back down to mitigate any open positions that were in opposite direction that were not mitigated, that could act as a good support and a good exit for short positions that are coming from distribution. So this is, again, having the ability to see the bigger picture about accumulation, distribution, and trends that take advantage of those accumulation and distribution exits. And within those trends, this is where we'll see order blocks, this is where we'll see demand zone and supply zone. And mostly for my entries, I look at the demand zones, I look at consolidation areas visually, and then I mark off order blocks on my charts and to prepare for them. And so, we'll go into charts right now and take a look at that on how that works. And this works in any market. It works in crypto, it works in index, it works in futures, in ETF, in stocks, in Forex, it works in all markets. So we'll start off with some examples on Bitcoin, and we'll switch to the SPYs, and you will see that it works in either condition, and it doesn't matter where things are. So let's look at consolidation areas. When we see this consolidation area, now because price was moving up, this is a distribution area and price comes down. So this area should be an area of interest for the future, should be an area of interest. And as I mentioned earlier, it could be years, could be months before we revisit these areas. And so then what I want to do is mark off before price made its wild move to the downside, where I started to see lows were taken out. This is where I mark off the order blocks. And the order block for bearish is the last bullish candle before the bearish move. So the way I draw it is I draw it from the open to the high of that section. So that high could be the next candle to the wick. So from the open of that bullish candle to the wick high of that same candle or the next candle, whichever is higher. This is our order block. Now this order block has to be mitigated. Uh, in this instance, December 17, 2017, price created this order block, and then in January, price almost came to test this order block and to mitigate, but I don't see any mitigation. And for me, mitigation means at the very least touch the bottom of this block, preferably the middle of this block. And my entries are mostly the middle of the block is my preference. I need to see a close inside this block and see a reversal for my entry. But I'm getting too far ahead of myself, just focusing on the order block. And now as price moves down, then we start to see are there any highs, any recent highs that are taken out, any recent highs. So here we have this size taken out, this size taken out right here. So I know I have an order block. The last bearish candle open to the low of that bar or the subsequent bars. This is my order block. So what this tells me is that when price goes away and comes back to this order block to mitigate this last bearish action, that's my potential entry. Of course, I need to see signs. So what I want to see as price mitigates is that there's a strong sign of a reversal. I'm not blindly entering just because we are in a mitigation. It's not a blind entry. There has to be some strong signs that this is reversing, and that strong sign could come in a form of a divergence in our oscillators. It could be that, or it could be in a form of break of structure. So in this case, we are making lower lows, but our oscillator is remaining flat. So this is showing a good sign of reversal. So at the break of these highs, it's a potential entry with these lows as our stops, and then target something else. So let's not talk about targets, but this is just how I'm looking at order blocks, mitigation, and then how we take it from that mitigation. Like I said, not everything works 100% of the time. This has worked, and it all depends on where we are exiting, how we are setting up our exits. So it doesn't mean it didn't work in this case, for example, but if we didn't take our profits, then we didn't gain from here. But here we also see another order block. Up here we see an order block, the last bullish candle from open to that high. This is another order block that we will come and visit in the future. As we come here, we see another order block here because price has significantly moved down from that area. So this is another order block that I'm expecting some mitigation to occur, because smart money that has pushed the price up, they need to mitigate that move up because they have some positions still open. And then as you see, price kept reversing. Now for me, I know some people look at it differently. A previous order block could be valid for the future, but once it is mitigated, I take it out from my drawing. I don't want to see that drawing once it is mitigated. And as we make more and more bullish moves, there are a couple of order blocks that we can keep adding here. This high to open here, that's an order block, and then this whole area, because each bar is very small bar. I can just treat this whole last move here to this area as an order block. So it's not about perfection, but it's about finding that balance. Or it could be also looking at this because there was a last move here. This is also a valid order block because there was a bullish move before price kept making some wide moves to the downside. So then as you see, as price moves away, this, for me, this whole area here, this whole area is consolidation. This is the demand zone. This is the accumulation zone before price reverses. So I'm not looking at any order blocks in here. This is just a whole demand zone here, setting up for the next move up. And as you can see, on the next move up, price mitigated our closest order block. So I'm out there. That is mitigated. And if there was a signal for the short side, we would enter it. But as we know, this is an accumulation area. And in an accumulation, it is important to understand when price breaks out of that accumulation, it will use it as support. It will use it as support. So when we reached our previous order block up here, when we mitigated that order block, we know that price is very likely to maintain the bullish momentum because this was an accumulation. Accumulation where price tested it as a support and price continues. And as price continues, it also takes out this next order block. This is also mitigated. Again, because we had this demand zone, this Wyckoff accumulation zone without any terminal shakeoff, it just went straight up, but it's still an accumulation zone. Because of that, I am not treating this as a short entry. I am taking this out. I am not treating it as a short entry. And even though price has made lower highs and it had kept going down, I have confidence that we have reached an accumulation and price is moving up. And so the next couple of order blocks are still very close to my entry area, as they're still very close to this consolidation, to this accumulation area. Therefore, as price has mitigated these order blocks, I delete them for my view. All of these order blocks are mitigated. Now, as price is making its way up, I want to take the last bullish or bearish candle before price went to the upside. So there are a couple of those scenarios. There is this one here. There's this area here, and then there's again this area, or you could consider this, you can consider this. There are a couple of, again, for me, I don't try to find perfection. I just find if it's close enough, if that's what it looks like to me, if it looks like an order block, I mark it. And as price keeps moving away from it, I look for a retest of that order block, or it could be left unopened. So this order block is already mitigated. I see that twice. It reached there twice. So I take that out and I move. So I'm doing this as the day progresses, right? So every day I'm monitoring. I'm monitoring. When price hits my order block, I remove that order block and look for other signs, other order blocks on the opposite side. So this area could be a distribution, or it could be a reaccumulation, because we have come down from the lows, and I'm just trying to see what price does. And here, our order block got hit. You see, I'm not looking at the right as I am drawing these, right? I'm shifting the chart as they develop. So this order block got mitigated right here. And as price is starting to make its way down, I'm going to assume this could continue to make its way down. So the last bullish candle, this one, or I'll just use these sets because they're very, very small candles. I'll just use this set. This is my order block. I'll treat this as my order block. This is my order block, and I have this order block that is just mitigated, so price keeps moving. And as you can see, that order block got mitigated, but price didn't collapse and go further down, but we came back and mitigated this and rejected at that mitigation. So it's possible price could continue to go down. And the last bearish candle is this candle here. And again, when it's small, I just like to expand it and see what is happening here. When order blocks are close together, I'm not in a hurry to enter positions. I want a clear indication. This is almost like a sideways movement biased to the downside, but order blocks are starting to get tighter and tighter. I want to see that broken. Boom. This order block is mitigated. This order block is mitigated. And now price keeps moving. Right? Price keeps moving. Price keeps moving. We have new order blocks up here. The last bullish candle before price made lower lows. That's an area. And then here we have consolidation. We have consolidation, 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 and here our order block is mitigated. This is where I said when you reach the bearish order block, I don't always enter it immediately for a bearish side. I don't always short it because I don't know the depth of that position. When price has been grinding up and down slowly, I rather see a good trend formed and enter at the low, at the demand zone, or at the supply zone if it's a bearish trend. So I want to get a clear indication of the trend. It's okay that I'm missing some trends because these small trends is not what I'm looking for. I don't want to look at charts hourly on this cryptos. I don't want to look at charts on minute by minute basis. I want to be able to take a look at a daily chart, pull a trigger, and be able to just sleep at night and not have to worry about it on a day by day basis because I'm waiting for price to take me from order block to order block. And as you can see, this order block got mitigated and price drove up, and then here we made another order block here, the last bearish candle before price started to take out the lows. So when these lows were taken out, here's my order block. And this order block that was formed a while back, we'll go back. So this order block was formed in April 29, 25th of April 29. That's when that order block was formed. And it got mitigated. It got mitigated on about a year later, March 2020. That's when it got mitigated, about a year later. So it got mitigated so I can take it out. I don't have to look at it again. And here we have a very, very bearish move down, and price started to grind its way back up, and I am forming another order block here. And I will keep these until they get mitigated. So here the one on the upper side got mitigated, I'm taking it out. So I'm just showing you exactly how I'm drawing these order blocks, how I'm looking at demand zones and supply zones. So I'm not focusing on entries for this particular training. I'm focusing on showing you the potential zones where price could reverse, where we see a good pullback and a reversal of that pullback for an entry, whether it's a long entry or a short entry. So every time you go back and find these order blocks, many times they are going to get mitigated. And for me, my entry is at the mitigation point, not at the initiation point. Because as I said earlier, I am not seeing this drawing until some of these highs are taken out. When I start seeing some of these highs taken out, this is when I start drawing my order blocks. And you know, as more and more highs get taken out, I can add more order blocks. Last bearish candle before an up move that takes out a high, that's a good order block. So that's how I go about it. I don't see any significant order blocks for the downside, and if I had entered this as an order block, it got mitigated right away. Then there's a sideways consolidation and price kept going higher and higher, and then I have another order block here from the open to the high. So open to the high on the bearish order block, open to the low on the bullish order block. That's how I look at it. And so here, this order block got mitigated right away. And look, our long-term order block from way back here, December 17, it took a while, but you know, starting in November 2020, 3 years later, we filled the whole order block. This whole thing is mitigated. Within an uptrend, I don't enter short positions. Look, this short position did not live more than 2 days. It closed below 1, 2, done. On the third day, it reversed because it took care of this order block already. And so now we have a couple of order blocks that are unmitigated, and we keep making higher highs, and we have more order blocks that we need to put in place somewhere here. So we have some order blocks, and then price started to take out these lows. So this was an order block, but it got mitigated right away. So I am not going to draw it for you. It got mitigated right away. And then on this side though, when price started to make higher highs, here's an order block here. And it almost got mitigated. It touched. You can consider it done, or it can continue to go up again, because this is a bullish momentum. This is what I want to see. This order block tested, preferably mitigated, and then reverse to the upside. So this is on Bitcoin, and let's just do a couple in SPY. As you can see, I'm doing this on the daily chart. You can go down to a lower time frame. You can go down to a higher time frame. It all depends on when you want to do it. And for this, let's just have some fun, and let's just do a replay. Let's just randomly put, okay, I'm not going to look, and I'm just going to click. That's my random click on when this starts. Okay, so on July 12, 17. So I want to start to look at this and see where price is starting to give us some order blocks, right? Because here, July 12th, as I mentioned, the last significant down move that I see before price broke the highs. So the way I draw it again, from the open of that bearish candle until the low, it could be that same day or the next day, whatever bar makes a low wick, that's where I draw it. This is my order block, and now we just play it out and see what price does. And I will pause it when I see another order block made. So price continues to move up. Price continues to move up. I'll pause it here, and here I see potentially this other order block here, but I'm going to delete this, and I'll tell you why I delete this. Because the very third bar mitigated this order block already. So let me draw it again so you can see what happens inside that block. We already have that mitigation. Not the very next bar, because that bar is just the reversal of that continuation to the upside, but price went back, mitigated, and continued. So I'm going to take this out as an order block because I see it already mitigated. There's nothing wrong with getting it wrong at times, right? It's just about giving us an edge to trade. That's the purpose. So that's what we are doing. And as price is going sideways but making lower highs, but then they keep getting mitigated. So price is moving. The replay is really nice because we have no future looking charts. It's all backwards. It's all from this point on. So let me pause it here, and I see we're starting to make new highs. So I'm gonna give myself another order block here, the last bearish candle. And if you want to do the last bearish candle as this one, as the other ones are just too small, that is also an acceptable bearish candle, and take it all the way to the lows, and that's a good order block as well. So that's also an acceptable order block. So let's play it out. As you can see, price is making some strong moves to the upside. I don't see any order block on either side yet. Okay, I can pause here, and here I see an order block here because price made new highs. So this is another order block, almost got mitigated but not quite. And if you say the last bearish bar is this next bar as well, but from high to low, slightly up here, being precise, now we could say this got mitigated because it already went inside of it. But that mitigation was not far enough for us to pull the trigger, but then it got mitigated here for sure. So this is definitely out. And here we have this couple of candles, very small candles, always closing kind of above the previous day, and if not very close. So I'm just going to ignore this kind of candles, and then I'll wait for next mitigation, which I see here because from here to here, because price has made a new high. Because price keeps making a new high, and if price breaks these highs again, we will have another order block. So we have another order block here. But this order block is already mitigated. Not fully, but it's mitigated. It's not fully for me to find a good entry, but nevertheless it is mitigated for all practical purposes. So I'll just leave it there for fun, but it's the next one that we're probably going to target next. So price gives cranking, price keeps cranking. Okay, here, pause. Wow, as I said, we'll probably take out the lower one. So boom, this is mitigated, this is mitigated. Now we have this down here, not yet mitigated. We have this down here, not yet mitigated. Like I said, it's not a requirement for them to be mitigated. Now we have a bearish order block here. We have a bearish order block here. This bar, because it opened here and went inside this block, it's very, very close to being mitigated. Again, let's leave it there for now. This is mitigated for sure, and this got mitigated. There were a couple of them here and here, both of them got mitigated. So let's keep playing it out. So the reason why I'm showing you on two different market types, crypto and ETF, is just to say the same principle, the same theory applies to both of them. Everything remains to both of them. So here we have made another order block from here to here, but this order block is mitigated. This order block is mitigated. So this is mitigated. We can take it out. It doesn't have to be all the way in. I would love for it to be all the way in, but it is mitigated. So I'm going to take this one out. It is mitigated. And let's see what price does, which next order block it wants to take care of. Let me pause and show you. We made this high. This was an order block here, but it got mitigated before I had a chance to stop it. And even the one that I took out earlier, this one that I took out earlier, that I said was mitigated here and good enough, well, it decided it wants to close most of it, if not all of it. We have yet to see how far it wants to close, but the one above it got mitigated immediately. And we have left up here, we have left a bearish order block. So we're filling this, we have yet to fill this, and then we're going to come back and fill those. Those are liquidities that smart money is going to go after as they mitigate their positions. So this looks like it's got mitigated almost completely. Doesn't have to be all the way, can be halfway, can be just even a slight touch. And for a long entry, as long as we're maintaining above these lows and breaking this short-term structure, this is a good signal for entry. And now it looks like this is a consolidation area. So as we test the highs of this consolidation, and reverse. That's a good entry. So boom, we also now mitigated this order block. This order block is mitigated. I can remove it. Now I can add the next order block. The reason why I like removing my order blocks, as I said, some people use them as a reference for the future, but for me the reason I remove them is I don't want to clutter my charts. I want my charts to be as simple as possible. Once a day I'm looking at this. Every day is a bar, so a few months could pass by, a few weeks, could be a few days. Between mitigation and mitigation, July 26 to June 13, in a 6-month span, there were 2 or 3 mitigations that occurred already. So let's play these out. Just let's see a couple of them close, and then we will wrap up this session, and then we will see for a future video. I will put together precise entries based on these triggering. When we come to the mitigation, as we did here, we mitigated this. I'm not going to leave it, but we mitigated this. We just mitigated that. And we've created a new order block down here. We have a new order block. So as you've been able to see in this video, price really gravitates to these order blocks. Why is it stopping at these areas? Because they're order blocks. That's why these areas are very, very strong support. It's not a line that we draw. This is why support is an area, not a precise point. That's why order blocks give you a lovely area to work from. So price now, it's wanting to fill this order block and fulfill the mitigation. It touched it and it's gonna go in. Boom, it's now this order block is fulfilled. Now we have this order block yet to be filled. This order block just got filled. It's moving too fast because it's on a replay, but we can see this order block is filled, and we're gonna make new order blocks as we move along. So we have a new order block here, and we will play it, and next order block that is touched, we will wrap up this video. I think you get the idea. As price moves from order block to order block, price uses demand zones and supply zones for an area where momentum shifts. So it shifts at a demand zone, it shifts from down to up. At a supply zone, it shifts from up to down. And between those demand zone and supply zone, we get these order blocks that price gravitates to. This is where price really stops. As you see, price had a wild move down, and when it went through 2 order blocks, but at the second order block it stopped. It looks like at the first order block it's a very fast moving train that hit the brakes, and it took it some distance to stop. That's what it looks like. And when it got to the second order block, it stopped and reversed. While it's temporary, it's still reversed. So this order block is now fulfilled. This order block is now fulfilled. And as we end this session, what I will show you now is what are potential order blocks. Here I have an order block here, a bearish order block, the last bullish candle before the wild move down. And then the last bullish candle before the last move down. So we have this order block and this order block yet to be fulfilled, and if we play it, we will see where it ended. So here now we have a couple of order blocks that are still not fulfilled yet. And if we leave this, and I'm going to exit the replay, and as you see, all of those are fulfilled. Of course, the top ones are fulfilled from the bottom, but if we go back in time where we drew them, here are the two that we drew. They were both filled in January 2019. They were both mitigated. And just for fun, let's do this. Prior to this, what was the last potential mitigation? So price made a high here, so somewhere here is the last one here. Somewhere here is a order block. This is an order block. So if we go to the end, and where did price come down to for during COVID? So these were all fulfilled, so I'll remove them. These were all fulfilled. This was fulfilled. This was the last one that was yet to be fulfilled. Price came all the way down for COVID season, for that initial panic, and look, it almost stopped at that zone. And I'm sure if we went further, we could find another order block in this area. I'm sure there's more order blocks. That's why it's good to leave all order blocks until they are completely fulfilled. So the last order block is here. Bearish candle before price moves up. And you know, as these highs are broken, you see this. So these highs are broken, you come and draw your bullish order block, the last bearish candle for a bullish order block. And when we go to COVID, that's where we see price. Now this got mitigated and this got mitigated. Boom. This is how order blocks work. This is how supply zone and demand zone works. This is how Wyckoff accumulation and distribution give us good areas of support and resistance for the future. Based on those accumulation, support, and resistance, based on the order blocks that are preceding or following the demand zones and the supply zones, we have a good place for an entry. And when we enter at an order block, if we are following the trend, then I enter full load. My dump truck full is that's my position. When I'm not entering at an area of value, and if that area of value is not matching with an order block, then my entry is not a full size. I still enter, I still take advantage of these swings along the way. I still look at support and resistance, but order blocks are my strongest support and resistance. Whether it's a bullish order block or a bearish order block, they are my support and resistance. That's what I focus on. I know this was a pretty long video, but this really helps you understand order blocks, demand zones, and supply zones. And if you have any questions, please leave a comment and I will respond to your questions. And in the next video, over the next couple of days, I will go into precise entries based on those order blocks executing. Take care, everyone.